Hello, students. I'm sure you are excited about your finance specialization of MMS program, which is now starting. One of the subjects in this finance specialization program is derivatives and risk management. This is a new subject for many students. Some students are scared and they're not sure if they will be able to understand this concept, while there are many others who are very excited about the fact that they would be learning a new topic, new subject. Irrespective of the category that you falls into, I have made this video to ensure that you get to understand the concept of derivatives in a detailed manner. I have taken measures to ensure that the understanding is easy and simple. At the same time, this video and all subsequent videos will cover the concept of derivatives in detail so that you have thorough understanding of this subject. In case you have missed my lectures in college, this video will definitely help you refresh whatever you may have missed. So let me start with the lecture 1. In this lecture, you will be getting to know about derivatives and its core concepts which you have to learn at the beginning. So I have just put three scenarios here. The first one is about Infosys, which is expecting to receive $20 million from one of its clients 6 months from today and is not sure about um, what will be the price of USD to INR in 6 months from now. So, Infosys, as you know, it exports services and it gets paid in lieu of that. The payment may be in dollar or in some of the foreign currency depending upon the client. But all those payments have to be eventually exchanged into INR because INR is the base currency. And when you want to convert dollars into rupee, you want to know at what rate the conversion will take place. So since that is not known, there is an element of uncertainty, and all companies dislike uncertainties. Companies want a very predictable environment. The second scenario is of a company that has borrowed a 10% rate fixed 5 years back for 15 years. So we are in 2025. So imagine this company borrowed in 2020 at a rate of 10% for 15 years, which is up to 2035. And the current rate of interest is 8%, and the company feels that interest rate will go down further. So the company is paying higher rate because it borrowed at 10% fixed. And now it is worried that uh, rate which has come down to 8% may further go down, and that would cause loss for the company. Third situation is much more familiar situation, which I'm sure many of you know, that there is a farmer who is growing mangoes in Maharashtra and is not sure about what will be the price of mangoes 4 months from now. So imagine this is month of January. The farmer is growing the crop and wants to sell it in the month of May, but the farmer does not know at what price will the crops be sold. So all three situations talk about uncertainty or the risk, right? It's basically about future which is not predictable. So if future is not predictable, what can we do? We need to manage this risk which comes from the uncertainty of future events, right? And that's why derivatives becomes a very important tool to manage this risk. But even before we understand derivatives, let us understand what exactly are markets and where does derivative fit into this. So first thing that we need to know is the spot market, right? So in context of financial markets, the spot market is a market where financial instruments or commodities are bought and sold for immediate delivery and payment. So spot market means you go to the spot market, you buy financial instruments like equity, bonds, okay, uh, maybe a currency, okay, and commodity, and you exchange money and underlying immediately, right? So you give 1,000 rupees, you get shares. You give 1,000 rupees, you get gold. You give 1,000 rupees, you get UST. All three examples must help you understand what is this exchange all about. This means that transaction is settled on the spot, usually between T plus 2 days, which is when you trade, and within 2 days. Sometimes it can be T plus one also, or many times it can be on the same day, right? So this is how the spot market works. But what is the challenge of the spot market? It does not provide us price for the futures. In all three cases that you saw in the previous video, they were all about future, right? But here the spot market is giving price for today. So it is not solving my problem. It is not margin based or leveraged, which means you cannot make a small payment and do transactions in spot market. You have to make full payment. In derivatives is different where we will learn leverage in details, right? It does not alone help in risk management. Spot market cannot solve the risk management problem alone. So then the question arises as to what is the solution, right? So derivatives provides this solution. Where will you get solution to that these three problems that we had? One place to look at the solution is derivatives market. Derivatives help in deriving the price, right? So today there is a price, but using that you can derive the price for next 6 months, like USD case of Infosys. Today there is a USD INR rate, but you can use that rate to arrive at a price after 6 months. So that's the derivatives. However, to derive price, we need to know the price in the spot market. That's why spot understanding spot market is so important, correct? So using derivatives, we can find out what should be the price of USD INR 6 months from now. For example, that's where the derivatives comes into picture. Infosys was looking to find out the price using the spot market. It can derive the price. How the price gets derived, that anyway you will get to know as we go ahead. The derivatives market is the financial market for derivatives, financial instruments like future contract or options, which are derived from other forms of assets, right? So, derivatives is a market which derives its value from the value of some or the other asset. The asset could be equity, the asset could be fixed income, the asset could be currency, the asset could be weather, anything could be the asset, right? The market can be divided into two, that for exchange traded derivatives and over the counter derivatives. So within derivatives market, we have OTC market and over the counter market. So just to help you understand, derivatives is a product which derives its value from the value of any underlying asset. So if underlying asset is there, derivatives will definitely be there. Now, what is the legal definition of derivatives? Okay, so in India, we have an act called as SCRA, or Securities Contract Regulation Act. Under this act, we have the definition of derivatives. So, what is the definition? You can read it yourself. However, let me tell you the first one, the first line, which is a security derived from debt instrument, shares, loan, whether secured or unsecured, risk instrument or contract for differences or any other form of security. So it's very clear that derivatives, derive their value, and that's where the derivatives contracts start, right? It is a contract which derives its value from prices or index of prices of underlying securities. That is what is also derivatives. Derivatives can be commodity derivatives and any other derivatives that the government may decide to call it as derivatives. Now, what are the economic functions of derivatives market? So first thing that it does, which we have already discussed, is the risk management. If you are uncertain about the price in future, you can go and lock the price in derivatives market. You can buy something today itself for 6 months from now, and you know the price today itself. So there is a risk. Uncertainty is gone and risk is managed. Risk is managed when there is no uncertainty. When the outcome of an event is known, there is no uncertainty. Please note. So risk is managed by the derivatives market. Then there is a price discovery. The price in the spot is known to you because you can go and buy yourself. But to know the price in derivatives, it has to be discovered, right? It enhances liquidity because the same thing is getting traded at two places. It is traded in spot, it is traded in derivatives. So if something gets traded at different places, there's higher liquidity because people have to take position in spot also and take position in derivatives also. And derivatives have been responsible for what is often called as product innovation. They have been very helpful in creating new and new products. And the financial markets have seen multiple innovations. Thankfully, they have happened because of derivatives. Now, as I told you, we have two types of platform, OTC and exchange traded. That is what was there in the definition. Exchange traded is a common platform for all traders, all investors, all individuals, right? It has a restricted access. In OTC, only handful of people can transact, mostly two people. There is a price transparency, which means whatever is traded on exchange is known to everyone. You can also get to know at what price Reliance is trading. But OTC trades, they are not known. right, to others, except when it is disclosed. There is a very low transaction cost in because there is a huge setup already built up. There are market players, there are brokers who transact for you, and because of competition they charge you very limited or lower fees. In OTC there is a high cost and it can be a time consuming process. You will have to negotiate the price, you will have to enter into a contract and all that. Absence of counterparty risk, what does it mean? It means that whenever you trade you are the party and there is a counterparty. So if the other party does not pay you, okay, then you have a counterparty risk, and that counterparty risk is absent in case of derivatives. Exchange traded derivatives, not derivatives. Exchange any product on exchange traded. Counterparty credit risk is there in OTC because you are doing deal with someone who may not pay you, and then you have that risk. Market prices are available to the wider world, similar like transparency, price transparency, difficulty in price dissemination. It's a standardized contract size. The exchange fixes everything, right? It is a customized contract. Which one? OTC, right? So, what are the examples of derivatives, futures, and options, which are exchange traded? Typically, options can also be OTC, but they are exchange traded also, and swaps forwards are the examples of OTC transaction. Just to elaborate a little bit on standardized contract versus customized contract. In case of a standardized contract, okay, the contract is already fixed in advance. You can buy, for example, one lot. You can buy only between 9:30 to 5 o'clock or 3 o'clock. Like, everything is very, very fixed. Here, everything is customized, which means you can decide how you want to transact. Okay, so OTC gives that flexibility. Now, let us move further and let us look at the questions below based on whatever we have discussed. So, derivatives is a contract which derives its value from value of an underlying asset. So, this is value. In the spot market, transaction is settled by exchange of goods and prices. I mean, exchange of goods and money. So, you exchange money and goods or instruments and goods. Derivatives initially emerged as a risk management product because derivatives, that's how they started. Derivatives help us in arriving at a price of future debt. It is not today's price, it is the price of future, right? Buying an asset without paying full money and carrying forward the position is called as leverage. This is what is called as leverage. Leverage means when you buy something but you do not pay full money, it is leverage. Let me give you an example. When you buy a house, okay, you don't pay full money. You only pay a part of the total money, but you own the house. For example, you may buy a house by paying 20 lakhs, but the house value is a crore rupees, right? So that needs to be understood in, and that is related to the concept of derivatives. Right? Now, who are the key players in derivatives? One is the speculator. Speculator are those who speculate the price that it will go up in the days to come, it will go down. They are looking at price movement, potential price movement, and accordingly taking position in derivatives market. Then we have hedgers. Who are the hedgers? Hedgers are those who want to reduce the risk. So, hedging means reducing the risk. Okay. Whenever you hedge, the intent is to reduce the risk. And then we have arbitrageurs who look at difference between spot price and derivatives price and try to make money from that. So spot and derivatives price, when they are not logically same, then an arbitrage opportunity arises. So arbitrage opportunity arises when price of the same thing is different in two different markets. So in one market you are trading USD INR at one price, in the other market you are trading at a different price. So this will result into creation of what is called as arbitrage opportunity. What are the types of derivatives? So here we are just looking at the name. There are four types of derivatives that you need to know: forward, futures, options, and swaps. Please note that all these derivatives will be explained in detail in the subsequent video. But as of now, for your understanding, if you ever want to learn derivatives, you end up learning four things: forward, futures, options, and swaps. So if equity is the underlying asset, then we can have equity forward, equity futures, equity options, and equity swaps. So, as you can see, we have four instruments, and for every underlying, there could be four derivatives contracts. So, if it is a debt instrument, then we can have interest rate forward, interest rate future, interest rate option, and interest rate swap. If it is currency, then we can have currency forward, currency futures, currency options, and currency swaps. Like that, you can create different contracts, right? So the idea behind making this video was to give you the bird's eye view of what is derivatives and to help you understand the broader context of derivatives. I hope you were able to understand whatever I discussed in this video, but in case you want any help, please do not hesitate to write to me on healthofmywealth at gmail.com, or you can also put comment in the comment box for any explanation that you would need. Thank you for your valuable time, and please do watch the next video, which will be lecture 2.